Winning traders treat the market as a business, not a casino. While the losing majority chase hot tips and revenge trade their emotions, the elite 10% follow systematic rules, cut losses ruthlessly, and let winners run. The difference isn't strategy complexity, it's the courage to do what feels uncomfortable. Most traders know what to do. Few possess the discipline to actually do it when real money is bleeding. Emotional mastery vs. emotional trading. The single greatest separator between the winning 10% and the losing 90% isn't intelligence, capital, or access to information. It's emotional control. Jesse Livermore himself emphasized that the market is designed to exploit human psychology, and those who cannot master their inner world will inevitably be destroyed by the outer one. The winner's mindset ice in the veins. Elite traders understand that emotions are the enemy of rational decision-making. When they enter a trade, they've already decided their exit points, both for profits and losses, before a single dollar is at risk. This pre-commitment removes emotion from the equation. When a stock hits their stop loss, they exit without hesitation, without hope, without prayer. There's no attachment to being right. They view each trade as a probability game, where losses are simply the cost of doing business. A losing trade doesn't wound their ego because their identity isn't tied to any single position. These disciplined traders maintain what Livermore called sitting tight, the ability to hold winning positions through minor pullbacks without panicking. They trust their analysis and let their profits run, understanding that one monster winner can offset 10 small losses. This requires superhuman patience in a world of instant gratification. The loser's trap. Riding the emotional roller coaster. The 90% operate from a completely different psychological framework. They let fear and greed, the market's two most powerful forces, control every decision. When a position moves against them, fear whispers, "It'll come back, just hold on a little longer." Hope replaces strategy. A 5% loss becomes 15%, then 30%, as they average down, throwing good money after bad. Conversely, greed makes them take profits too early. The moment they see green, fear of losing those gains triggers premature exits. They sell winners after 5% gains, only to watch them soar 50% higher. This creates a devastating pattern: small winners and massive losers, the mathematical formula for account annihilation. Worse still, emotional traders engage in revenge trading. After a loss, ego demands they immediately recoup their money. They abandon their strategy, increase position sizes recklessly, and enter low probability trades just to get even with the market. This emotional death spiral has destroyed more accounts than any market crash. The FOMO epidemic. The losing majority also suffers from fear of missing out. When stocks rocket higher without them, they chase at peak prices, buying tops driven by euphoria rather than analysis. When everyone's talking about a stock, when it's on every news channel, that's when amateurs pile in, and precisely when professionals are exiting. The bottom line. Emotional mastery isn't about eliminating feelings. It's about refusing to let them dictate actions. The 10% feel the same fear and greed as everyone else. They simply don't act on it. They've developed systems, rules, and habits that override emotional impulses. Trading success demands treating your psychology with the same rigor you apply to chart analysis. Until you master yourself, the market will master you. Risk management is non-negotiable. Jesse Livermore's most powerful lesson wasn't about picking winners, it was about surviving losers. The fundamental difference between the elite 10% and the failing 90% boils down to one critical principle: winners obsess over protecting capital, while losers obsess over making money. This seemingly subtle distinction creates dramatically different outcomes. The winners formula capital preservation first. Professional traders operate with an iron-clad rule. Never let a small loss become a large one. Before entering any position, they've already determined their maximum acceptable loss, typically 1–2% of total capital per trade. This isn't a suggestion, it's a commandment written in stone. When price hits that stop-loss level, they exit immediately without hesitation, negotiation, or hope. This disciplined approach creates mathematical safety. Even with a brutal losing streak of 10 consecutive trades, they've only lost 20% of their account. They live to trade another day, maintaining the psychological and financial capital needed for the next opportunity. The 10% understand that preservation of capital is the prerequisite for compound growth. Elite traders also employ position sizing that reflects risk. They don't bet 50% of their account on a sure thing. Instead, they calculate position size based on the distance to their stop loss, ensuring consistent risk across all trades regardless of stock price or volatility. A 100 stock with a tight stop might warrant more shares than a 20 stock with a wide stop. It's about dollars at risk, not share quantity. The loser's delusion hope as a strategy. The 90% approach risk management with fatal optimism. When a trade moves against them, they don't see a stop loss as protection. They see it as locking in a loss. Their internal dialogue becomes, if I don't sell, it's not really a loss yet. This is financial suicide disguised as patience. What starts as a 5% pullback becomes a 15% drawdown, then 30%, then 50%. At each stage, they rationalize holding. It's too late to sell now, or it has to bounce back eventually. They transform what should have been a minor scratch into a gaping wound. Many traders have watched a single position destroy months or years of profits because they refuse to accept a small, manageable loss. The amateur mindset also manifests in catastrophic position sizing. They bet too much on individual trades, sometimes risking 20–30% of their account on one position. A few bad trades in succession, and they're mathematically eliminated, down 60–70% with no realistic path to recovery. The averaging down trap. Perhaps the most dangerous behavior is averaging down on losing positions. The 90% see a stock they bought at $50 now trading at $40 and think, it's an even better deal now. They double down, lowering their average cost. When it falls to 30, they add more. This violates the cardinal rule, never add to a losing position. They're throwing life preservers to a sinking ship. The mathematical reality. Risk management isn't glamorous, but it's the difference between survival and extinction. A 50% loss requires a 100% gain just to break even, a mathematical hole most never escape. The 10% know that defense wins championships in trading, just as in sports. Patience over action. In a world that glorifies constant activity, the most counterintuitive truth in trading is this: doing nothing is often the most profitable action. Jesse Livermore famously said, "It was never my thinking that made the big money for me. It was always my sitting." The elite 10% understand that trading success isn't measured by how often you trade, but by how selectively you trade. The losing 90%, however, confuse activity with productivity, and it costs them everything. The winners discipline strategic inactivity. Professional traders spend most of their time doing absolutely nothing. They watch, they wait, they analyze, but they don't pull the trigger unless conditions align perfectly with their strategy. They've identified specific setups that offer genuine statistical edges, and they refuse to deviate from these criteria, no matter how boring the wait becomes. This patience manifests in two critical ways. First, they wait for high probability entry points. They don't chase stocks that have already moved 20%. They don't jump into trades because they're bored, or because their account has been flat for weeks. They understand that capital preservation during mediocre conditions is just as important as capital appreciation during optimal ones. Second, once in a position, they exercise the patience to let their thesis play out. If they've identified a stock that could run 50%, they don't bail at 10% just because the position makes them nervous. They've done their homework, set their stops, and they trust their analysis enough to sit tight through normal volatility. This is where fortunes are made, in the patient holding of winning positions. The 10% also recognize when market conditions don't favor their strategy. During choppy, directionless markets, or when their setups aren't appearing, they simply step aside. Cash is a position. Sitting on the sidelines preserving capital while others churn their accounts is a competitive advantage disguised as inaction. The losers' compulsion over trading to death. The 90% are allergic to patience. They suffer from what can only be described as action addiction. If they're not in a trade, they feel like they're missing out. They open their trading platform each morning with an unconscious commitment to do something today. This need for constant engagement is financially devastating. These traders enter marginal setups that don't meet their criteria simply because they can't stand watching from the sidelines. They trade out of boredom, not opportunity. They convince themselves that something might work out, even when their strategy doesn't signal a clear entry. This scattered approach generates excessive commissions, constant small losses, and mental exhaustion. Overtrading also stems from desperation. After a losing streak, amateur traders feel pressure to quickly recover their losses. They increase their trading frequency, taking progressively lower quality setups, which only accelerates their account's deterioration. They're trading their emotions, not their edge. The FOMO spiral. The losing majority also jumps into trades late after missing the initial move. They see a stock up 15% and think, I need to get in before it goes higher. They're acting on fear of missing out rather than strategic opportunity. By the time the crowd notices a move, professionals are often preparing their exits. The wisdom of waiting. Great trading isn't about finding something to do every day. It's about finding the right thing to do and waiting for it to appear. The market rewards patience and punishes impatience. The 10% know that boredom is a small price to pay for profitability. Following the tape vests following opinions. Jesse Livermore built his fortune on one fundamental principle. The market is always right, and opinions are always suspect. The critical divide between the winning 10% and the losing 90% lies in their information sources. Elite traders read price action and let the market speak its truth, while the majority chase tips, headlines, and guru predictions, always arriving too late to the party and too early to the funeral. The winner's approach, the tape tells all. Professional traders are students of price action. They watch how stocks actually behave, not how analysts say they should behave. Volume patterns, support and resistance levels, momentum shifts, and trend strength provide objective data that reveals what the market is actually doing in real time. When a stock breaks resistance on increasing volume, that's information. When it fails to hold support despite positive news, that's also information. The 10% understand that price is the ultimate truth. It reflects the collective wisdom of millions of participants risking real capital. Everything worth knowing, insider activity, institutional accumulation, changing fundamentals, shifting sentiment, eventually shows up in price movement. Livermore himself mastered reading the tape, allowing him to detect major moves before they became obvious to the crowd. These traders also practice independent analysis. They may read research and listen to perspectives, but they verify everything against what the chart shows. If their analysis contradicts the prevailing narrative, but aligns with price action, they trust the price. They've learned that being right while the crowd is wrong is where asymmetric profits live. Crucially, winners adapt to what the market shows them rather than forcing the market to conform to their predictions. If they're bullish but price action turns bearish, they don't dig in stubbornly. They adjust or exit. The market doesn't care about your opinion, and neither should you. The losers trap trading by rumor and narrative. The 90% are perpetual followers. They scan social media for hot stock tips, chase newsletter recommendations, and make decisions based on CNBC headlines. They treat trading like gathering insider secrets rather than analyzing objective data. Did you hear about XYZ stock? Everyone's saying it's going to explode! This reliance on secondhand information creates a disastrous timing problem. By the time a stock tip reaches the amateur trader, the move has often already happened. The professionals who did actual research bought weeks earlier at lower prices. When the story finally hits mainstream media and reaches the retail crowd, smart money is preparing to sell into that enthusiasm. Amateurs become exit liquidity for professionals. The losing majority also falls victim to confirmation bias. They decide they want to buy a stock, then seek out bullish opinions to validate that decision while ignoring contradictory evidence. They follow charismatic gurus on social media who predict with certainty, not realizing that anyone can sound confident, but the market determines who's actually correct. The news trap. Perhaps most destructive is trading based on news headlines. Amateurs see Company X beats earnings and rush to buy, only to watch the stock plummet because the beat was already priced in or guidance disappointed. They don't understand that news is already old information the moment it's published. The reality check. Price action is objective reality. Everything else is opinion, speculation, or marketing. The market doesn't lie, but people do, sometimes to themselves most of all. The 10% trust what they can measure and observe, not what they hear or hope. System and consistency beat genius. The greatest myth in trading is that success requires exceptional intelligence, secret indicators, or insider connections. Jesse Livermore's legacy reveals a far more humbling truth. Consistent execution of a proven system trumps brilliance every time. The elite 10% succeed not because they're smarter, but because they're more disciplined. They follow repeatable processes without deviation. The losing 90%, meanwhile, are trapped in an endless cycle of strategy hopping, perpetually searching for a magical solution that doesn't exist. The winner's blueprint boring consistency. Professional traders build systematic approaches and stick to them with religious devotion. They've identified specific criteria for entries, exits, position sizing, and risk management. And they execute these rules mechanically, regardless of how they feel on any given day. Their edge isn't complexity, it's consistency. A winning system doesn't need to be sophisticated. It might be as simple as buy stocks breaking above 52-week highs on heavy volume, risk 2% per trade, exit when momentum fades. The power isn't in the strategy's novelty. It's in following it faithfully through winning streaks and losing streaks alike. The 10% understand that any edge, however small, compounds dramatically over hundreds of trades. A system with a 55% win rate and proper risk-reward ratios can generate substantial wealth, but only if executed consistently. They meticulously track every trade, review their performance, and refine their approach incrementally based on data, not emotions. These traders also embrace the mundane reality of their edge. They know which setups work for them and repeat those patterns endlessly. While it might feel boring to trade the same setup for the 100th time, that familiarity breeds expertise. They become masters of their specific approach, rather than perpetual students of every approach. Crucially, winners give their systems time to work. They understand that any methodology will experience drawdown periods. A few losing trades don't signal a broken system, they're statistical inevitability. They've backtested enough to know their expected win rate and maximum drawdown, so they don't panic when normal variance occurs. The loser's curse, the holy grail hunt. The 90% are strategy nomads, wandering from method to method in search of the perfect system. They try moving average crossovers for 2 weeks, lose money, then abandon it for candlestick patterns. That doesn't work immediately, so they switch to options strategies, then pivot to momentum trading, then jump to value investing. They never stick with anything long enough to actually master it or understand whether it works. This constant switching guarantees failure. Every methodology requires time to learn its nuances, develop pattern recognition, and build genuine competence. But the losing majority operates on a dangerous assumption. If it's not working immediately, it must be the wrong system. They confuse normal variance with system failure. Amateur traders also suffer from shiny object syndrome. They're seduced by complexity, believing sophisticated indicators and elaborate strategies must be superior to simple approaches. They create charts cluttered with 20 indicators, producing contradictory signals that paralyze decision-making. Complexity becomes a crutch that masks the real problem: lack of discipline. The compounding power of repetition. The irony is profound. The 90% pursue genius while the 10% practice consistency. One approach leads to chaos and losses. The other builds wealth systematically. Success in trading isn't about finding the perfect system. It's about perfecting your execution of a good enough system. Master one thing rather than dabbling in everything. The uncomfortable truth about trading success. Jesse Livermore's wisdom echoes across a century because human nature remains unchanged. The division between the winning 10% and the losing 90% isn't drawn by intelligence, capital, or market access. It's drawn by discipline, patience, and emotional mastery. The battle isn't against the market, it's against yourself. The path is simple, not easy. The roadmap to trading success is deceptively straightforward. Control your emotions. Protect your capital religiously. Wait patiently for high probability setups. Trust price action over opinions. And execute a proven system with unwavering consistency. There's no secret here, no hidden knowledge that only the elite possess. Every losing trader knows these principles. The devastating truth is that knowing and doing are separated by an enormous chasm that most never cross. The 90% fail not because they lack information, but because they lack the psychological fortitude to act on what they know. They understand they should cut losses quickly, but hope whispers seductively when positions move against them. They know overtrading destroys accounts, but boredom and FOMO override rational decision-making. They recognize that consistency matters, but the promise of a better system always seems just one strategy away. The mirror reveals everything. Trading is the ultimate mirror. It reflects your discipline, patience, emotional control, and ability to follow rules under pressure. The market doesn't care about your bills, your ego, or your need to be right. It rewards process and punishes hope. Every weakness you possess will eventually express itself in your trading account as a realized loss. The elite 10% have made peace with this reality. They've accepted that trading success requires doing what feels uncomfortable, sitting patiently when action beckons, cutting losses when hope insists on holding, trusting their system when doubt creeps in, and remaining humble when ego demands validation. They've transformed themselves into trading machines, consistent, systematic, and emotionally detached. Your choice, your consequence. You now possess the same knowledge that separates winners from losers. The question isn't whether you understand these principles. It's whether you'll implement them when your money is on the line, when fear grips your chest, when greed whispers in your ear, when everyone around you is doing the opposite. Will you join the disciplined 10% who treat trading as a business built on proven processes? Or will you remain among the emotional 90% who treat it as a casino driven by hope and hunches? The market will answer that question for you, one trade at a time, one decision at a time, one moment of discipline or weakness at a time. Jesse Livermore showed us the way. The choice to follow it has always been, and will always be, entirely yours. The market doesn't create winners and losers, you do.